But what's the way forward and what are the internals looking like? Let's get in more details and let's connect with Krishnan Sitaraman, who's the Senior Director and Chief Rating Officer at Crisil's Rating. A very good morning and thank you so much for your time. First up, help us understand that how do you see the whole situation panning out within the banking space? Because just a while back, sir, we were talking about the liquidity crunch in the banking system. SBI had to help the banking system abate this liquidity crunch into the system. But now that this issue has been a bit subsided, how is the banking space growing at this point in time?
Yeah, thank you so much for having me on the show. Very good morning, everyone. Now, if I look at the entire growth and liquidity conundrum, I think we should just set a little bit of a context and go back to FY25. That was a year when we saw a reduction in bank credit growth due to multiple reasons. We had 2 consecutive years of 16% growth, that's FY23 and 24. The growth came down to 11 to 11.5%, and there were multiple reasons. So one, the lower deposit growth rate. Number 2, the banks were themselves being cautious on lending to unsecured segments due to asset quality concerns. Thirdly, the credit to NBFCs, which is the largest segment among corporate borrowers, that was subdued due to increase in risk weights for that sector. And there was an elevated inflation and interest rates for the bulk of the year. Now in FY26, and of course, the lower deposit growth rate, one of the reasons was the tighter liquidity, which we saw for the bulk of the year. In FY26, we believe that there will be a mild turnaround, as you said, 100 to 200 basis points, resulting in around 12 to 13% credit growth. And a few reasons for that. One is risk weights for NBFCs have been brought down, which will lead to banks being more comfortable lending to the sector. We expect increased consumption demand and hence higher retail credit growth due to a trifecta of reasons. One is the tax relief measures of the recent union budget, 2, the lower interest rate, and 3, the lower inflation levels expected this fiscal. And also banks are expected to lower lending rates, and that will create its own credit demand. Now, specifically on the liquidity side, the RBI's action in the last few weeks have certainly eased the liquidity in the system. And I was listening to what Bala sir was talking about a little while earlier, 5 lakh crore of liquidity has come in. So while deposit growth was constrained for much of last fiscal by the tight systemic liquidity, by the end of March 25, we saw liquidity turning to surplus, and it has remained so in April. So with the RBI also in the last monetary policy assuring adequate liquidity for the course of the fiscal, we expect the scenario to be more benign going ahead, and that should support deposit growth and in turn credit growth.
All right, but along with that, what we are seeing is that all these banking majors are now cutting down their saving deposit number, the rate that they were offering, and that's after the latest RBI decision. But
we have current and savings deposits as well as your term deposits. So what we have been seeing in recent time is some reduction in the savings deposit rates as per following what the RBI has indicated in terms of their policy rate reduction. But what we have seen on the term deposit side is that the rates are not coming down, and in certain cases banks have indeed increased interest rates depending on what their asset liability maturity situation is looking like and in which buckets they need more deposits. So what we have seen is that overall we do expect some element of impact on the profitability of the banking system this fiscal, because on the lending side, because of the interest rates coming down, they will have to lower interest rates on their loans. Many of the loans, over 40% of them, are linked to external benchmark link rates. So when the repo rate falls, they will have to reduce the lending rates on those accounts. So the lending rate will come down. Deposit rate, while it will come down, it may not come down to the same extent, because deposits actually on the balance sheet reprice with a lag, because it is only the incremental deposits and the renewals which come at the lower rate. So the net interest margins of banks may get impacted by around 10 to 20 basis points this fiscal is what we are expecting.
All right, but help us understand that how do you see the gap between the credit growth as well as deposit growth to pan out in the times ahead?
2 years and track the trajectory. We've seen deposit growth and credit growth having a gap of around 500 bips. So the deposit growth was 500 bips lower than credit growth 2 years back. That came down to 300 bips a year or so back, and now it is around 100 bips. So steadily the difference is coming down, and that's largely because the credit growth has come down. Now, if we look at and one of the key reasons is the tightened liquidity situation and alternate avenues for depositors to deposit their or place their money, invest their money in. Now we are seeing, as we discussed earlier, the improved liquidity situation. And what we are seeing is in the term deposit side, we have not seen rates come down. So because of both of that, we don't expect going forward too much of a difference between the credit growth and deposit growth this fiscal. While deposit growth will still come at a rate lower than credit growth, the gap will not be that much. That said, we do expect the current and savings deposit proportion that could come down because the interest rates there are coming down, as you mentioned, for certain banks. So the CASA levels, which are at around 33% on a systemic basis, that could come down marginally. But overall deposit growth rate, we still believe the difference with the credit growth rate will not be too much this fiscal.
Okay, hi, Mr. Sitaraman. This is Snehi also joining in the conversation. Now that we've spoken about how banks stand to get impacted from this regulation, what do you make of how NBFCs are placed amid this entire regulation? Because we understand that for NBFCs, RBI has reduced the risk weight by 25 bips for certain categories. So what's the impact on NBFCs, and who do you think is going to be more impacted when it comes to banks versus NBFCs?
Structurally, whenever there is a reduction in interest rate in the environment, we see the banks, the profitability gets impacted because the deposits reprice with a lag, asset side comes down. Conversely, when interest rates go up, bank profitability gets favorably impacted. As far as the NBFCs are concerned, it's the other way around. When the interest rates come down, their profitability gets favorably impacted because if you look at a lot of their loans outstanding are on fixed rate basis, whereas a lot of their liabilities could be on floating rates. So floating rate prices will come down, whereas the lending rates may not come down to that extent. So NBFC overall profitability will get impacted, but it will be different for HFCs. For housing finance companies, you will have a bulk of their loans on floating rate basis. So there also it needs to come down. There it will be a kind of a comparison between how much of their loans are on floating rate basis, how much of their liabilities are on floating rate basis. But on the HFC side, there could be a reduction in profitability. But for other NBFCs like vehicle loan companies, there would be a slight uptick in the profitability solely account of the interest rate reduction. That said, there could be some bit of an uptick on the credit costs because of the asset quality situation that we expect a marginal increase in NPAs. So it is possible that the increase in credit cost would broadly offset the gain in the NIMs for the NBFCs on a systemic basis, and hence their overall profitability on a ROMA or return on managed assets basis, we are expecting that to be fairly steady. But on credit growth for NBFCs, we are expecting an uptick vis-a-vis last year. One is because of the underlying demand for retail credit would go up because of the reasons I talked about earlier. And on the other side, the access to funding will become easier than last fiscal, where the banks had gone cautious in lending to NBFCs. NBFC credit growth came down to around 6% on bank books, as against 20-25% plus in the previous years. So we expect bank credit to be more liberal to NBFCs this fiscal, and that would also help in taking NBFC credit growth up by a notch as compared to the last fiscal.
All right, Mr. Krishnan, with this, we let you go on that note. Thank you so much for taking the time out and speaking with us and giving us a sense that what could be in the store for the banking space when it comes to FY26 and the outlook. Thank you so much for that.
Thank you.
If you like this video, then like, share and subscribe to ET Now.